You've been programmed to fail from day one, and the worst part is you don't even know it. While you're analyzing charts and backtesting strategies, the real moneymakers are playing a completely different game that nobody talks about. Here's the brutal truth about trading. 90% of traders lose money consistently, not because they're stupid or unlucky, but because they're following a system designed to drain their accounts. Meanwhile, that elite 10% who actually make money, they know something the masses don't, and they're definitely not sharing it in their YouTube courses or Twitter threads. I've spent the last 12 years studying both sides of this equation. I've watched countless traders blow up their accounts following the exact same patterns, making the exact same mistakes over and over again. But I've also had the privilege of working alongside some of the most successful traders in the industry, and what I discovered will probably shock you. The 10% who consistently profit aren't just better at reading charts or managing risk. They operate from a fundamentally different understanding of what markets actually are and how they really function. They see opportunities where others see chaos, and they profit from the very mechanisms that destroy everyone else. Today, I'm going to pull back the curtain on this hidden world. I'll show you exactly why the traditional approach to trading is mathematically designed to fail, reveal the psychological traps that keep traders stuck in losing cycles, and most importantly, expose the core principles that separate the winners from the losers. But here's what makes this even more valuable. I'm not just going to tell you what the successful 10% do differently. I'm going to show you the specific mindset shifts, the tactical approaches, and the strategic frameworks they use to consistently extract money from markets while everyone else struggles. Before we dive deep into these secrets, let me give you some context about why this matters so much right now. The retail trading industry has exploded over the past few years. Millions of new traders have entered the markets, armed with apps, indicators, and dreams of financial freedom. Most of them will lose everything within their first year. This isn't an accident or a coincidence. The entire retail trading ecosystem is structured to encourage behaviors that lead to consistent losses. From the way brokers make money to how trading education is packaged and sold, everything pushes new traders toward failure. The successful 10% understand the system intimately. They know how to navigate around these traps, how to think differently about risk and reward, and most importantly, how to profit from the predictable mistakes that everyone else makes. Let me start with the most fundamental misconception that destroys trader after trader. Most people approach trading like it's a skill you can master through practice and dedication. They think if they just study enough charts, learn enough patterns, and backtest enough strategies, they'll eventually become profitable. This belief is not just wrong, it's dangerously misleading. Trading isn't primarily about technical skill or market knowledge. It's about understanding human psychology, market structure, and probability in ways that most people never consider. The losing 90% focus obsessively on being right about market direction. They want to predict where prices will go next, and they measure their success by how often their predictions come true. This approach feels logical and satisfying, but it's actually the fastest way to lose money consistently. Here's why this mindset is so destructive. Markets are fundamentally unpredictable in the short term. Even the most sophisticated analysis can't tell you with certainty what will happen next. When traders focus on being right, they inevitably fight against this uncertainty instead of learning to profit from it. The winning 10% have completely flipped this script. They don't try to predict market direction with precision. Instead, they focus on creating systems that can profit regardless of what markets do next. They understand that being wrong is inevitable, so they built their entire approach around managing and profiting from uncertainty. This leads us to the first major difference between winners and losers. Successful traders don't trade markets, they trade probabilities. Every decision they make is based on statistical edges that play out over hundreds or thousands of trades, not individual predictions about specific price movements. When most traders look at a chart, they see patterns and try to predict what comes next. When successful traders look at the same chart, they see probability distributions and risk-reward scenarios. They're asking completely different questions and making decisions based on entirely different criteria. The losing majority also falls into another devastating trap that the industry actively encourages. They treat trading like gambling, constantly seeking the next big win that will change their lives overnight. This mentality leads to position sizing that's too large, holding periods that are too short, and emotional decision-making that destroys any edge they might have had. Professional traders approach this completely differently. They treat trading like running a business, where consistent small profits compound into significant wealth over time. They're not looking for home runs. They're building systems that can generate steady returns while managing downside risk. This business mindset affects everything about how they operate. Their position sizing is calculated mathematically based on account size and risk parameters. Their entry and exit criteria are defined before they place any trades. Their emotional responses are controlled through systematic processes that remove discretionary decision-making from critical moments. But here's where it gets really interesting. The successful 10% don't just think differently about markets and risk. They also understand something profound about market structure that most traders never learn. Every trade has two sides, and for every winner, there must be a loser. This isn't just a philosophical concept. It's a mathematical reality that shapes everything about how markets function.
The question becomes, which side of this equation do you want to be on? Most retail traders unknowingly position themselves as the losers in this equation. They trade in ways that benefit the very institutions and professional traders they're competing against. They provide liquidity when smart money wants to exit, and they buy when professionals want to sell. The winning minority understands this dynamic and deliberately positions themselves on the other side. They've learned to identify when retail traders are likely to make predictable mistakes, and they structure their trades to profit from these behaviors. This isn't about being smarter or having better information. It's about understanding the game being played and choosing to play it from a position of strength rather than weakness. The successful traders know that markets are ultimately about the transfer of money from impatient traders to patient ones, from emotional traders to systematic ones. Here's another critical insight that separates winners from losers. The failing majority treats each trade as an isolated event that needs to succeed on its own. They put tremendous pressure on individual trades to perform, which leads to overanalyzing entries, micromanaging positions, and making emotional decisions when trades don't immediately go their way. Successful traders understand that profitability comes from the performance of trading systems over large sample sizes, not from individual trade outcomes. They know that even the best trading strategies will have losing streaks, and they design their entire approach to survive and profit through these inevitable periods. This system thinking completely changes how they interact with markets on a day-to-day basis. Instead of hoping each trade will be a winner, they focus on executing their process consistently and letting probabilities work in their favor over time. The psychological difference this creates is enormous. When you know that individual trades don't determine your success, you can make decisions based on logic rather than emotion. You can cut losses quickly because you're not emotionally attached to being right. You can let winners run because you're not afraid of giving back profits. But there's an even deeper level to this that most people miss entirely. The truly successful traders don't just have better systems and psychology, they've also learned to see opportunities that others completely overlook. While everyone else is fighting over the same obvious setups and following the same predictable patterns, the winning 10% have developed the ability to spot value where others see nothing at all. They've trained themselves to recognize market inefficiencies that exist for only brief moments before being corrected. This isn't about having access to secret information or using expensive software that retail traders can't afford. It's about developing a completely different perspective on what constitutes a trading opportunity. Most traders look for confirmation that their analysis is correct before entering positions. The successful minority looks for situations where the majority is likely to be wrong. They understand that the best opportunities often appear when market sentiment reaches extreme levels in either direction. When everyone is bullish, they start looking for selling opportunities. When panic dominates headlines and charts, they begin positioning for recoveries. This contrarian approach feels uncomfortable and counterintuitive, but it's precisely this discomfort that creates the edge. The losing 90% also makes a critical error in how they think about time horizons and market cycles. They want immediate gratification and quick results, so they focus on short-term price movements that are essentially random noise. This approach puts them at a massive disadvantage because they're trying to extract predictable profits from unpredictable price action.
Professional traders operate on completely different timescales and think in terms of cycles rather than individual price movements. They understand that markets move through predictable phases of accumulation, markup, distribution, and decline. By aligning their strategies with these larger cycles, they can position themselves to profit from moves that unfold over weeks or months rather than minutes or hours. This longer-term perspective also allows them to ride out the short-term volatility that shakes out impatient traders. While retail traders are panicking about daily fluctuations, professionals are focused on the bigger picture and the structural factors that drive sustained price movements. Here's another crucial distinction that most people never recognize. The failing majority approaches trading as if it's about them versus the market. They see price movements as personal attacks on their positions and take losses as evidence of their inadequacy as traders. This creates an adversarial relationship with markets that leads to revenge trading, overconfidence after wins, and devastating emotional spirals after losses. The winning 10% understand that markets aren't personal. Prices move based on the collective actions of millions of participants, not because the market has any opinion about their individual trades. This perspective allows them to remain objective about their performance and make decisions based on data rather than emotions. They've also learned to separate their self-worth from their trading results. A losing trade doesn't make them a bad trader, and a winning trade doesn't make them a genius. They evaluate their performance based on process execution rather than short-term outcomes, which keeps them focused on the factors they can actually control. But perhaps the most important secret that successful traders guard closely is their understanding of what really moves markets over time. While retail traders focus on technical indicators and chart patterns, professionals pay attention to the underlying forces that create sustained trends and major turning points. They know that real money is made by identifying and positioning for structural shifts in market conditions, not by trying to scalp profits from minute-to-minute price fluctuations. These structural shifts might be driven by changes in economic policy, shifts in global capital flows, or evolving investor sentiment around specific sectors or asset classes. The ability to recognize these larger forces requires a completely different skill set than what most trading education focuses on. It requires understanding economics, geopolitics, and institutional behavior rather than just memorizing chart patterns and indicator signals. Here's where the gap between winners and losers becomes almost insurmountable. The successful minority has learned to think like the institutions they're trading against, rather than like retail traders trying to outsmart the market. They understand how large funds make decisions, what factors drive institutional buying and selling, and how to position themselves to benefit from these flows. This institutional perspective reveals opportunities that are invisible to traders thinking on a retail level. When institutions need to accumulate large positions, they can't just buy everything at once without moving prices against themselves. They have to be strategic about their entries, which creates predictable patterns that sophisticated traders can exploit. The winning traders have also mastered something that destroys most people's accounts faster than anything else. They've learned to control their position sizing and risk management with mathematical precision rather than emotional guesswork. This isn't just about setting stop losses or using proper risk-reward ratios. It's about understanding how position size affects your psychology, how correlation between positions impacts overall portfolio risk, and how to structure your trades so that even a series of losses won't significantly damage your account. They use position sizing as a weapon that allows them to be aggressive when opportunities arise while protecting capital during unfavorable periods. The losing majority treats position sizing as an afterthought, if they consider it at all. They risk too much when they're confident and too little when they should be pressing their edge. This backwards approach to risk management ensures that their losses will always be larger than their gains over time. Most importantly, the successful 10% has developed an understanding of market psychology that goes far deeper than basic concepts like fear and greed. They know how different types of market participants behave under various conditions, and they can predict with remarkable accuracy how crowds will react to specific events or price movements.
This psychological edge allows them to position themselves ahead of predictable market reactions. When they see conditions developing that typically trigger retail panic selling, they prepare to buy. When they recognize the signs of euphoric buying that usually precedes major tops, they begin reducing positions or preparing short strategies. The ability to stay one step ahead of crowd psychology is perhaps the most valuable skill a trader can develop, and it's something that can only be learned through years of careful observation and disciplined execution. The truly devastating part about all of this is how the entire trading industry actively works against retail traders while convincing them it's helping. Every broker, every trading course, every piece of software is designed to keep you trapped in behaviors that generate profits for someone else. Think about how brokers make money. They don't profit when you succeed. They profit from your activity. The more you trade, the more they earn in spreads and commissions.
This creates a fundamental conflict of interest where your broker benefits from keeping you active and engaged, regardless of whether you're actually making money. The successful 10% recognizes this immediately and structures their approach to minimize these parasitic costs. They trade less frequently, hold positions longer, and focus on strategies that don't require constant market interaction. Meanwhile, the losing majority gets caught in a cycle of overtrading that slowly bleeds their accounts dry through transaction costs alone. But the manipulation goes much deeper than just commission structures. The entire educational ecosystem is designed to teach concepts that feel sophisticated, but actually increase your chances of failure. Technical analysis, for example, gives traders the illusion of control and predictability while keeping them focused on short-term noise rather than long-term edges. Professional traders use technical analysis very differently than retail traders are taught. They don't use it to predict future price movements. They use it to identify areas where other traders are likely to make predictable mistakes. When they see a textbook chart pattern forming, they're not thinking about which direction price will break. They're thinking about how retail traders will react to that break and how to position themselves accordingly. So there you have it, the brutal reality behind why most traders fail and what separates the elite few who actually make money. The difference isn't about intelligence or luck. It's about understanding that you're not just trading markets, you're trading against a system specifically designed to extract money from unprepared participants. The successful 10% didn't stumble into profitability by accident. They deliberately learned to think, act, and position themselves completely differently than everyone else. Now you know their secrets. The question is, what are you going to do with this knowledge?